Hello everyone, and welcome back to Topical Economics. In today's video, we're diving into the topic, price elasticity of demand. We will be going through some multiple choice questions from past papers to reinforce these concepts and see how they're tested. Whether you are new to this topic or just want to check your concepts and revise, this video will be helpful for tackling key concepts on price elasticity of demand. So, grab your notes, stay focused, and let's see if you can get them all right. And as always, make sure to subscribe so you don't miss out on more helpful content. Let's get started. Starting with the first question. A cinema has 500 seats. It raised its admission price from $2 to $5 and daily revenue increased from $800 to $1,500. What can be concluded from this information? A. Price elasticity of demand for cinema seats was elastic. B. Price elasticity of supply of cinema seats was elastic. C. The cinema operated below full capacity. D. The cinema's profits rose by $700. This question is from year 2022 May-June version 3 paper. The correct answer for this question is C. The cinema operated below full capacity. The cinema has 500 seats, which would mean a full capacity revenue of. At the original price of $2 per ticket, 500 times 2 is equal to $1,000. At the new price of $5 per ticket, 500 times 5 is equal to $2,500. The reported revenue increase from $800 to $1,500 implies that even after the price rise, they did not sell out all 500 seats. This suggests they operated below full capacity since they could have made up to $2,500 if every seat was filled. Let us analyze other options also. A. Price elasticity of demand was elastic. Demand appears inelastic since revenue increased with the price increase. B. Price elasticity of supply was elastic. The information given doesn't provide insight into the supply elasticity for cinema seats. D. Cinema's profits rose by $700. There is no information provided on costs, so we cannot determine profit changes. Going to the second question. Which statement about price elasticity of demand, PED, is correct? A. PED measures the percentage change in quantity demanded divided by the percentage change in price. B. PED measures the change in price divided by the change in the quantity demanded. CPED means a change in price will cause an equal change in the quantity demanded. DPED means a change in demand will result in a greater percentage change in price. This question is from year 2022 May-June version 3 paper. The correct answer for this question is A. PED measures the percentage change in quantity demanded divided by the percentage change in price. Price elasticity of demand, PED, is a measure of the responsiveness of quantity demanded to a change in price. Let us evaluate the other options as well. Option B incorrectly reverses the calculation by stating it as a change in price divided by the change in quantity demanded. Option C describes unit elasticity, where PED is exactly 1, which only applies in specific cases and is not a general description of PED. Lastly, option D incorrectly describes PED as a change in demand causing a greater percentage change in price, which does not define PED. Thus, option A correctly describes the calculation of PED. Moving to third question. In the diagram, which demand curve has perfectly elastic demand? This question is from year 2022 May-June version 2 paper. In a diagram, a demand curve that represents perfectly elastic demand is a horizontal line. Perfectly elastic demand means that consumers will only purchase at a specific price, and any increase in price will result in quantity demanded dropping to zero. A horizontal line on a graph indicates that at one particular price, any quantity can be demanded, but even a small increase in price will cause demand to fall to zero. So, in this diagram, the demand curve with a horizontal line is D, which represents perfectly elastic demand. Moving to fourth question. In a country, the total demand for vehicle fuel is price inelastic. However, the demand for any given brand of vehicle fuel is price elastic. If brand X increased its price by 10%, what would be the most likely effect? A. Consumer spending on vehicle fuel would decrease. B. The prices of other brands would fall. C. The revenue from brand X would increase. D. The revenue from other brands would increase. This question is from year 2022 February-March version 2 paper. The correct answer for this question is D. The revenue from other brands would increase. Since the total demand for vehicle fuel is price inelastic, consumers' overall demand for fuel will not significantly change with price changes. However, the demand for any specific brand, such as brand X, is price elastic, meaning that consumers are sensitive to changes in the price of that specific brand. If brand X raises its price by 10%, consumers will likely switch to other brands to save money, reducing the quantity demanded for brand X. This shift in demand to other brands would result in increased revenue for those competing brands as they capture brand X's former customers. Let us analyze other options as well. Option A is incorrect, because total consumer spending on fuel is not likely to decrease significantly if demand is inelastic. Option B is unlikely because other brands don't need to lower their prices. Instead, they would benefit from increased demand as consumers switch from brand X. And option C is incorrect, because with price-elastic demand, brand X's revenue would likely decrease as quantity demanded falls in response to the price increase. Moving to fifth question. In the diagram, which line represents perfectly price-elastic demand? This question is from year 2022 February-March, version 2 paper. The correct answer for this question is D. This is similar to the third question we just saw. Moving to the sixth question. The diagram shows the demand curve for rice. What is the price elasticity of demand, PED, for rice as price increases from $1 to $1.50 per kilo? Options are A. 0, B. 1, C. less than 1, D. greater than 1. This question is from year 2021 October-November version 3 paper. Let us analyze this. Price elasticity of demand, PED, is calculated as the percentage change in quantity demanded divided by the percentage change in price. In the case of essential goods like rice, demand is typically price inelastic, PED1, meaning that quantity demanded does not change significantly with price changes. For this question, we can calculate that the percentage change in quantity demanded is 10% and the percentage change in price is 50%, thereby giving the correct answer as Option C. less than 1. This option reflects inelastic demand, where the percentage change in quantity demanded is smaller than the percentage change in price. Moving to the seventh question. The table shows the quantity demanded at different prices. For which fall in price is the demand price inelastic? A. From $6 to $5. B. From $5 to $4. C. From $4 to $3. D. From $3 to $2. This question is from year 2021 October-November version 2. To determine when demand is price inelastic, we need to identify the price decrease that causes a relatively smaller percentage change in quantity demanded compared to the percentage change in price, i.e., PED1. Let us calculate the percentage changes in both price and quantity for each price fall and identify where PED is less than 1. PED equals percentage change in quantity demanded divided by percentage change in price. For option A, PED equals 1.5. For option B, PED equals 1. For option C, PED equals 1.6. And for option D, PED equals 0.86. So the correct answer for this question is option D. Proceeding with the eighth question. The price elasticity of demand, PED, for bottled water is -0.9. What will happen to the quantity demanded for bottled water if its price increases by 10%? A. Decrease by 0.9%. B. Decrease by 9%. C. Increase by 0.9%. D. Increase by 9%. This question is from year 2021 October-November version 1 paper. The correct answer for this question is option B. Decrease by 9%. Price elasticity of demand, PED, is calculated as the percentage change in quantity demanded divided by the percentage change in price. Given that the PED for bottled water is minus 0.9, a 10% increase in price will lead to a percentage change in quantity demanded of percentage change in quantity demanded equals PED multiplied by the percentage change in price, that's equals minus 0.9 multiplied by 10% equals minus 9%. The negative sign indicates a decrease in quantity demanded. Thus, if the price increases by 10%, the quantity demanded for bottled water will decrease by 9%. Moving on to ninth question. How might the concept of price elasticity of demand, PED, be useful for a government? A. To determine the effect on employment of a change in income tax. B. To determine the effect on government revenue of a rise in the rate of interest. C. To determine the effect of providing a public good. D. To determine the result of imposing a tariff on imports. This question is from year 2020 Specimen Version 1 paper. The correct answer for this question is Option D. To determine the result of imposing a tariff on imports. Price elasticity of demand, PED, measures how responsive the quantity demanded is to changes in price. When a government imposes a tariff on imports, it raises the price of imported goods. Knowing the PED for these goods helps the government predict how much demand might decrease in response to the higher price. If the demand for imports is price elastic, PED1, a tariff might significantly reduce import demand. If the demand is price inelastic, PED1, a tariff may have a smaller impact on quantity demanded and could raise significant government revenue without drastically reducing imports. When we look at the other options, Option A, employment and income tax, Option B, government revenue and interest rate, and Option C, public goods, do not directly involve changes in price or demand sensitivity, so PED is not directly applicable to these areas. Proceeding with the 10th question. In an African country with large areas of tropical desert, the price elasticity of demand for salt is highly inelastic. This will result in greater consumer expenditure on salt when price changes from P to P2. Which diagram illustrates this situation? This question is from year 2020 October-November version 3 paper. In a situation where the price elasticity of demand, PED, for salt is highly inelastic, the demand curve will be steep, indicating that a change in price leads to a relatively small change in quantity demanded. For this question, this is the case with option D as we see. So correct answer is D. Proceeding with the 11th question. The price of bread rose by 5% and the quantity demanded fell by 4%. What was the price elasticity of demand for bread? A. Minus 0.4. B. Minus 0.8. C. Minus 1.25. D. Minus 2.0. This question is from year 2020 May-June version 2 paper. We know that PED equals percentage change in quantity demanded divided by percentage change in price. We have been given percentage change in quantity demanded equals minus 4%. Percentage change in price equals plus 5%. So, PED equals 5% minus 4% equals minus 0.8. The price elasticity of demand for bread is Option B minus 0.8. This indicates that the demand for bread is inelastic, meaning that the percentage change in quantity demanded is less than the percentage change in price. Proceeding with the 12th question. Price elasticity of demand, PED, measures the responsiveness of demand to a change in price. It can differ for different goods. For which good is the PED most elastic according to the table? This question is from year 2019 October-November version 3 paper. Given the details in the table, we can easily calculate PED. For butter, PED equals 1.2, for cars, PED equals 1.1, for furniture, PED equals 1.0 and for petrol, PED equals 0.6. The good with the most elastic demand is butter, with a PED of 1.2. This indicates that the demand for butter is the most responsive to price changes among the listed goods. This question is from year 2019 October-November version 2. Proceeding with the 13th question. A railway company increases ticket prices by 10% for travel between 6 o'clock and 9 o'clock, causing a reduction in demand by 2%. After 9 o'clock, it reduces ticket prices by 5%, resulting in a 7% increase in demand. What is the price elasticity of demand in response to these price changes? We can calculate PED between 6 o'clock and 9 o'clock equals minus 0.2. This indicates that the demand is inelastic because the absolute value of PED, 0.2, is less than 1. And we can calculate that PED after 9 o'clock equals minus 1.4. This indicates that the demand is elastic because the absolute value of PED, 1.4, is greater than 1. Thus, the correct answer is Option C, inelastic, between 6 o'clock and 9 o'clock, and elastic, after 9 o'clock. Moving on to question 14. The demand for gas in a country becomes price inelastic. What will happen as a result? A. Gas workers will be less likely to be successful in obtaining wage increases. B. Gas workers will be more likely to be successful in obtaining wage increases. C. Total expenditure on gas by consumers will fall when its price rises. D. Total expenditure on gas by consumers will rise when its price falls. This question is from year 2019 May-June version 3 paper. The correct answer for this question is Option B. Gas workers will be more likely to be successful in obtaining wage increases. When the demand for gas becomes price inelastic, it means that consumers are less responsive to price changes. That is, a price increase leads to a smaller percentage decrease in quantity demanded. Because gas is often considered a necessity, especially in countries where people rely on it for transportation and heating, consumers will continue to buy it even if prices rise. This stability in demand can lead to increased revenues for gas companies, making them more financially able to accommodate wage increases for workers. Let us also analyze the other options. Option A. Gas workers will be less likely to be successful in obtaining wage increases. This is incorrect because inelastic demand supports higher revenues for firms, enabling potential wage increases. Option C. Total expenditure on gas by consumers will fall when its price rises. This is incorrect. Total expenditure will likely rise because consumers will continue to buy nearly the same amount despite higher prices. And Option D. Total expenditure on gas by consumers will rise when its price falls. This is incorrect in the context of inelastic demand. Total expenditure will not rise as much if the price falls since the quantity demanded doesn't increase significantly. Moving on to question 15. A product has a price elasticity of demand of 0.5. What happens to the demand for a product if its price falls from $1 to 80 cents? A. It decreases by 10%. B. It decreases by 20%. C. It increases by 10%. D. It increases by 20%. This question is from year 2019 May-June version 3 paper. Percentage change in quantity demanded equals PED times percentage change in price. Given, PED equals minus 0.5. Percentage change in price equals minus 20%. So, percentage change in quantity demanded equals minus 0.5 times minus 20%, which equals 10%. That is, the demand for the product increases by 10% when its price falls from $1 to 80 cents. The correct answer to this question is Option C. It increases by 10%. Moving on to question 16. A mobile cell phone operator increases the price of making calls on its network. After the price increase, the revenue of a mobile phone operator falls by 10%. What is the price elasticity of demand, PED, for the mobile operator service? A. Elastic. B. Inelastic. C. Perfectly elastic. D. Unit elastic. This question is from year 2019 May-June version 2 paper. To determine the price elasticity of demand, PED, for the mobile operator service, we can analyze the relationship between the change in price and the change in revenue. It is given that the price of making calls increases. The revenue of the mobile phone operator falls by 10%. We know that when demand is elastic, PD1, a price increase leads to a more than proportionate decrease in quantity demanded, resulting in a decrease in total revenue. When demand is inelastic, PD1, a price increase leads to a less than proportionate decrease in quantity demanded, resulting in an increase in total revenue. When demand is unit elastic, PD equals 1, a price increase results in no change in total revenue. Here, since the revenue falls by 10% after the price increase, this indicates that the demand for the mobile operator's service is elastic. In this case, the decrease in revenue due to the price increase shows that the quantity demanded decreased significantly compared to the price increase. Thus, the correct answer for this question is option A, elastic. Moving on to question 17. What can be concluded from the demand curve for the product shown in the diagram? This question is from year 2019 May-June version 2 paper. The correct answer to this question is option A. Since the demand is inelastic, a price increase will lead to a smaller percentage decrease in quantity demanded, thus increasing total revenue for producers. If we look at the other options given to us, option B, producers are unable to respond to a price rise, is incorrect. Producers can respond to price changes. The ability to respond is not determined by the elasticity of demand. Option C, the product is one with many substitutes, is incorrect. Inelastic demand typically indicates fewer substitutes, as consumers are less responsive to price changes. And option D, there are 20 people able to buy the product, is incorrect. This does not directly relate to the characteristics of the demand curve. It does not accurately reflect demand in terms of quantity or price. Moving to question 18. The table shows the demand and supply for spices in a market in Africa. When the price rises from $20 to $30 per kilogram, what is the price elasticity of demand, PED, for spices? A. 0.25. B. 0.5. C. 1.0. D. 2.0. This question is from year 2018 October-November version 1 paper. Here, as price rises, we can calculate that percentage change in quantity demanded equals 25% and percentage change in price equals 50%, thereby giving PED equals 0.5. So the correct answer for this question is option B. Moving on to question 19. The table shows the demand for chocolates at two different prices. What is the price elasticity of demand when the price falls from 50 cents to 45 cents? A. Less than 0.5. B. Between 0.5 and 1. C. Between 1 and 1.5. D. Greater than 1.5. This question is from year 2018 February-March version 2 paper. Given the data, we can calculate that percentage change in quantity demanded is equal to 20% and percentage change in price is equal to minus 10%. So the PED equals minus 2. Since we are interested in the absolute value for elasticity, PED equals 2. So, option D, greater than 1.5, indicates that the demand for chocolates is elastic, meaning consumers are relatively responsive to price change. Proceeding with question number 20. The table illustrates the demand and supply for coffee in a market in Africa. When the price rises from $20 to $30 per kilogram, what is the price elasticity of demand for coffee? A. 0.2. B. 0.5. C. 2.0. D. 5.0. This question is from year 2017 October-November version 1 paper. Similar to the 18th question that we just saw, the correct answer for this question is option B, 0.5. Proceeding with question number 21. The table shows 4 people's demand for t-shirts at 2 prices. Who has the most elastic demand for t-shirts when the price rises from $10 to $15? A. Elsa. B. George. C. Hamid. D. Shara. This question is from year 2017 May-June version 3. Given the data, we can calculate that for Elsa, PED equals -1 unit elastic. For George, PED equals -1 unit elastic. For Hamid, PED equals -1.33 elastic, and for Shara, PED equals -0.4 inelastic. Here, Hamid has the most elastic demand for t-shirts when the price rises from $10 to $15. The correct answer is thus option C, Hamid. Proceeding with question 22. A football club raises all stadium seat prices by 5%. The stadium is divided into 4 zones. The demand for seats falls by 1% in Zone W, by 3% in Zone X, by 5% in Zone Y, and by 6% in Zone Z. In which zone is the responsiveness of demand for seats to the price change elastic? A. Zone W. B. Zone X. C. Zone Y. D. Zone Z. This question is from year 2017 May-June version 1 paper. To determine in which zone the responsiveness of demand for seats to the price change is elastic, we need to calculate the price elasticity of demand, PED, for each zone using the formula. PED equals percentage change in quantity demanded divided by percentage change in price. Given information is percentage change in price equals plus 5%. So we can calculate PED for each. For Zone W, PED equals -0.2, inelastic. For Zone X, PED equals -0.6, inelastic. For Zone Y, PED equals -1.0, unit elastic, and for Zone Z, PED equals -1.2, elastic. Thus, the zone where the responsiveness of demand for seats to the price change is elastic is option D, that is, Zone Z. Proceeding with question 23. A product has a price elasticity of demand that is greater than 1. What will happen to total revenue if the price of the product is reduced by 3%? A. It will fall by more than 3%. B. It will fall to 0. C. It will be unchanged. D. It will rise. This question is from year 2017 February-March version 2 paper. If a product has a price elasticity of demand, PED, greater than 1, it indicates that the demand for the product is elastic. In this scenario, when the price decreases, the quantity demanded increases significantly. Since demand is elastic, the percentage increase in quantity demanded will be greater than the percentage decrease in price. On analyzing price reduction, the price is reduced by 3%. And elastic demand, PED1, this means the increase in quantity demanded will be proportionately larger than the price decrease. Thus, as a result of the price reduction, total revenue will rise because the increase in quantity sold outweighs the decrease in price. Therefore, the correct answer for this question is option D. It will rise. Proceeding with question 24. The demand for cocoa beans is price inelastic. What is most likely to decrease as a result of an increase in demand for cocoa beans? A. Price of cocoa bean products. B. Production of cocoa beans. C. Profits of cocoa bean producers. D. Unemployment among cocoa bean farmers. This question is from year 2016 October-November version 3 paper. The correct answer for this question is option D. Given that the demand for cocoa beans is price inelastic, an increase in demand could indeed lead to a situation where unemployment among cocoa bean farmers could decrease because producers may need to hire more workers to meet the increased demand. If the market responds effectively, this could lead to a reduction in unemployment. Proceeding with question 25. A product has a totally inelastic price elasticity of demand. What will happen to total revenue if the price of the product falls by 25%? A. It will fall by 25%. B. It will fall to 0. C. It will remain unchanged. D. It will rise by 25%. This question is from year 2016 February-March version 2 paper. Total revenue is equal to price multiplied by quantity demanded. Since the quantity demanded does not change due to inelastic demand, we can say that if the price falls by 25%, total revenue will decrease because the lower price will result in lower total revenue despite selling the same quantity. Thus, total revenue will fall because the product is totally inelastic, and the revenue lost from the price drop will not be compensated by any increase in quantity sold, which does not change. Therefore, the correct answer to this question is option A. It will fall by 25%. Proceeding with question 26. A company decided to reduce the price of its product by 10%. What would happen? A. The firm's costs would decrease if the elasticity of demand was greater than 1. B. The firm's profits would increase if the elasticity of demand was greater than 1. C. The firm's revenue would increase if the elasticity of demand was greater than 1. D. The quantity sold would decrease if the elasticity of demand was less than 1. This question is from year 2015 October-November version 1 paper. Total revenue is equal to price multiplied by quantity demanded. If a company reduces the price of its product by 10% and the demand is elastic, greater than 1, the percentage increase in quantity demanded will be larger than the percentage decrease in price, leading to an increase in total revenue. Therefore, option C correctly states that the firm's revenue would increase if the elasticity of demand was greater than 1. Thank you so much for watching. I hope you found this video insightful and helpful. If you enjoyed the content, please give it a thumbs up, and don't forget to leave your thoughts in the comments below. I'd love to hear from you. Make sure to subscribe to Topical Economics channel so you don't miss out on any of our future videos. Share this with your friends who might also find it useful, and stay tuned for more exciting content coming your way.